Well today. I am Gianni DePoce. I am a trader and an observer of the markets, and I'm really excited to be here with Benzinga and Cboe, otherwise known as the Chicago Board of Options Exchange. We have a really excited session coming up where we are going to be exploring current volatility and market trends with no other than Kristin Boyd from Cboe. So, Kristin, are you here? Yes, you are. How are you, Chris?
Good. Good to see you, Gianni.
Good to see you as well. And I'm really looking forward to what you have to share with us. I think the timing of this conversation couldn't be better, given what has gone down here in the first quarter in 2025. And we're going to talk about this volatile environment in addition to what we can do to take advantage of it. Conversation about what I think is going to be happening in terms of volatility going into the second quarter. So I think the timing couldn't be better, and I'm really looking forward to going over this with you.
Me too. Thanks.
All right. So what do you have in store for us right now?
Yeah, great. So thanks so much for having me today. My name is Kristin Boyd. I run the global derivative sales and distribution team at Cboe. So I'm here today to talk a little bit about some of the bigger trends and themes and flows that we're seeing across our volatility markets. I'll give you some highlights across a number of the different options and futures franchises we have in the US. But we'll spend most of our time really talking about the S&P 500 and VIX families. So before we get into all of that, I'm going to run through just a couple quick disclaimers on the next slide. So for anyone here today, just reminding you that nothing I share today is investment advice. It'll all be my own personal views, and for any media on the call, welcome. The call today, from my perspective, will be off the record, but our communications team is on there. If there's anything you need from them after the call, please reach out. And so to kick off on the next slide, I wanted to give you just a quick snapshot of the world from Cboe's perspective in terms of where we operate, the types of risk that we see, and really the breadth of views that we have from a client perspective and an exchange perspective. So we operate in 27 markets around the globe. That crosses equities, FX, treasuries now on our FX platform, as well as our options and futures platforms in the US and Europe. Although I would say we're best known for really our S&P 500 franchise and the volatility products that we offer in the US and options and futures. On the next slide, just a short overview of what we are from a global derivatives perspective. So beyond the S&P 500 and VIX franchises, I'll give you some highlights on our Russell 2000 options ecosystem. It's really been an interesting product for us over the last year, especially since about a year ago, we expanded our expiries into 0 DTE there. We also have a family of options products with MSCI in the US, and that's an area that's been super interesting this year with the different divergences and views on the US from an economic perspective compared with the rest of the world. We also have a major footprint on the single stock and ETF options franchise. So those trade across 4 different options exchanges in the US. And we also have a franchise in Europe, which includes single names and indices in Europe. And as I alluded to before, we're starting to get a lot more inquiries on our European derivatives platform, especially as potential tariff and trade implications affect different companies in Europe compared with some of their US competitors. So on the next slide, I'll mention here briefly, and I'll go over this again at the end, but the QR code on the screen will take you to a link where if you'd like to sign up to get more regular commentary from us beyond the webinars that we do with Benzinga, you can register here. We have market intelligence franchise at Cboe, and we've really spent a lot of energy investing in the last year and a half in this platform. And what does this mean? So today I'm going to be talking a lot about the trading flows, really what are the volumes, to give you a sense about what other people are looking at. But Mandy Zhu, Ed Tom, and Henry Schwartz on our market intelligence team are putting out commentary every week, especially a franchise publication on Monday morning and then opportunistically throughout the week. So that's where you can stay up to date on the different themes, flows, and really what's moving and interesting in the volatility markets. So for those of you that really want to dig deeper into implied volatility, realized vol, skew, convexity, and what that means, I'm not going to get into that on this webinar today, but Mandy's team spends a lot of time talking about that. They've got a really great chart book as well that comes out on Monday morning. So encourage you, if that's of interest, follow the QR code, spend a little time on the website. There's a couple different series of publications that you can register for there. And on the next page, before we get into the meat of the presentation, just a reminder of where our credibility comes from in the volatility franchise. So options in the US have been trading for 50 years, and that coincides with Cboe's founding. So we are 51 years old as a company now and have been trading options on our exchanges in the US for over 50 years now. And of that, 40 years with the S&P 500 options and over 20 years now with the VIX options and futures family of products. And with that, Giovanni, I think we'll go ahead and get into it.
All right, great. My internet actually cut out there for a second, so I just popped back in. So you want to take a look at the S&P here?
Yeah, let's do it.
Okay, so let's go ahead and pull that up. Really interesting tape that we have here from my perspective. Obviously we were faced with a pretty significant sell-off after the S&P index hit a new all-time high in mid-February. And so, obviously when you look at the VIX, we're talking about the options premiums on the S&P 500. So the VIX had a pretty notable pop, although I will point out that on the latest rally that we saw in the VIX, there was some notable divergence between the VIX futures and the regular VIX index. So that's one of the things that I like to keep an eye on. But here today we saw that reversal from earlier in the week. Started off the week with a strong rally, gapping up, and we almost came back and filled this gap. And you often hear that going around in the trading community that gaps get filled. But just as a reminder, on this S&P 500 index, it's not trading 24 hours a day like the futures. So, the gaps, they'll go on a little bit longer, but no, not every gap needs to be filled. But we almost filled that gap from the open on Monday. And, one of the things that I like to do as a trader is, 9 out of 10 times I'm trading in the direction of the trend. And, one of the beautiful things about options and, the whole, reason why they exist is to help with hedging. So, the long-term trend in the S&P, obviously, you zoom out, it's up. You see higher highs and higher lows. It's as simple as that. Each high that follows the previous high is above the high that it followed, and then each low is above the low that it followed as well. So even with this pullback that we had here in the first quarter, I would like to point out that we haven't really taken out that low from August, and you can make an argument that we've taken out that low from January, but it doesn't stick out as much as that low from August. So to me, the longer term trend is still up. Short term, there's some issues in this market, and that's where volatility and the hedging comes in. So, where do we go from here? I like to take a look at these key levels in the S&P. This was a support zone, and support is simply defined as an area where on these charts you see more demand than supply. So go back to Economics 101 class. When demand exceeds supply, prices go up. But the thing to understand that when support breaks, it becomes resistance. So resistance is simply an area where supply exceeds demand. So right now, there's still a lot of supply overhead in the market right now, which warrants a little bit of caution. Now, I'm sure Kristin can comment on this, and I always like to talk about this when I'm discussing options. What is it, like 80 or 90% of options expire worthless? So, going out there and buying straight calls and straight puts on the direction of the market, the odds are not in your favor. So instead of taking directional bets, you can do things like spreads and strangles. There's a lot of different techniques out there that I'm not going to get into necessarily today, but just keep that in mind. I assume that most of the people are watching this have some sort of exposure on the long side of this market. So it could just be a matter of, selling some calls collecting some premium. That gives you a little bit of hedging, for the downside. And then if we clear this level that I drew on this chart, let's call it, 58.50, 59.50. I think at that point we have to kind of shift our outlook to more bullish strategies. So, that's how I'm looking at the S&P 500 right now. If there's anything else you wanted to add to that, Kristin, I can definitely talk some more about it.
Yeah, no, it's really interesting. And from an SPX perspective, and I'll show a few charts later, but we saw almost 4 million in ADV and options traded on SPX thus far in the month of March. And that's a meaningful pickup from last year as well as earlier this year. What's interesting about that, and continues to be alluded to, the use of spread trading, and in terms of gross notional, that close to 4 million ADV, it ends up being almost $2.2 trillion of gross notional exposure turning over every day. Sounds like a lot. It is. It's a lot of money. But really, when you dig into what's trading in those, a meaningful part of that ends up trading in spreads. So spreads being someone buys one option, sells another. Could be trade expiring on the same day, could be different days, but certainly the actual net risk and net exposure much larger than, or sorry, much smaller than that 2.2 trillion notional.
One of the things I like to look at to help measure sentiment and whether we're in a position where taking a contrarian stance may actually benefit you is the put call ratio, which I know that you guys have. So you have it for the equity side, you have the total put call ratio. Can you comment on that right now, or is that outside of your
yeah, no, I can mention, and one thing that's interesting about that put call ratio, and I started on Wall Street in 2004 as a summer intern, so the way we talk about that ratio has really changed since when I joined the markets compared with now. So if we were to think about the total SPX options that trade, over 50% of those trade in the 0 day to expiry tenor now. Actually, close to 75% of those are trading in that 0 to 7 day expiry. That's quite different from when I joined the market. And if you were to look at just the 0 days, that put call ratio ends up being pretty close to 1. If you were to look at longer dated options, yes, you still have more puts trading than calls, reflective of more traditional how people in the market for a long time think about it. But certainly that's reflective that in the 0 day to expiry and those short dated trades, that flow remains pretty balanced in terms of puts and calls.
Wow, that's really an amazing number. 50 to 75%. I mean, especially considering the 0 data option date to expiration. That's only been around for a few years, so it really has transformed the way we look at that put call ratio, then, hasn't it?
It has. It's really made it important that when you're looking at the types of indicators in the market, what I always say to the team is be specific. So it's quite easy to look at the put call ratio the way we looked at it for a long time, and use that. But it's really the advent in the last 3 years and the really growth in that 0 day to expiry trading has pushed us to just be so much more specific. And the indicators we use, as well as using those to think about what's really the duration of our trade, what's the exact bet we're making, made us, I'd say, a lot more informed as traders and market participants.
Well, I'm glad you mentioned that, because when you're trading options, it is a lot more than just direction of the market, right? You have to look at things like implied volatility. You have all the Greeks. There's more that goes into, pricing the option than just what the market is doing, right? If volatility is higher, you're going to be paying more, on those premiums. So all things to keep in mind. And then I know that on a lot of those 0 DTE options, there's a lot of people, a lot of traders out there taking big bets on a short period of time. That's not the way I like to trade. But, from what you're saying, it seems like it's become a very liquid market with a lot of people really, in that space now.
It has. What often surprises investors, and maybe less so than 2 years ago, because we spent so much time talking about it, it really surprises investors to hear, back to your point on the put call ratio, that it's so balanced. It also often surprises people to hear that The majority of those trades actually get closed out before the end of the day.
Yeah.
So there's so much intraday trading going on with investors taking different views, some directional views through put spreads and call spreads, buying or selling, some really just betting on the market being range bound that day. But really, it's that diversity of views and also utility trading strategies that I think is one of the factors to bringing so much flow and liquidity into that space, and still in a risk contained way in terms of most investors and the way they're looking to place those views.
Awesome. Well, I do want to take a look at what's happening in the VIX right now. So you can see here, and this is that divergence I was talking about. So you have the VIX and the VIX futures. You had a much bigger pop in the VIX futures more recently than you did in the VIX cash, if you will. But we still did take out that high from December. But right now the VIX is coming back down as the market rises. And that's pretty normal to see, I'd say, in a majority of circumstances. There will be those very rare instances where you'll see the VIX rally with stocks, but that doesn't happen very often. So I don't personally do all that much trading on the VIX futures, but it is something that I watch on a daily basis. I'm always looking at the VIX to help measure kind of what the risk appetite of the day is. So what are you seeing on your end in terms of activity in the VIX, and what's happening over at Cboe with this?
Yeah, so VIX has been a really active product for us over the last, for going on 20 years now, but of most interest really for this team in the last kind of 6 to 12 months, which is what I'll focus on here with my comments. So in the month of March, month to date, we've seen over 1.2 million in ADV in the contracts traded on the flagship VIX options. So on the page here, you'll see that ticker is VIX. So that's the top left on your screen. Those trade on the same exchange as SPX options. They're really the product that I think the most investors are familiar with. That high comes on the back of an August of 2024. So you remember when we had those big overnight market moves, bigger moves in the VIX, a lot of questions around unwinds and yen carry trades and things like that, really driving investors into SPX as well as into the VIX in terms of managing or monetizing their global equity and global risk exposure. So what really drives that big pickup in VIX index options volume, as well as a meaningful pickup in VIX futures volumes with over 300,000 lots a day trading on the futures side. And that tends to be when investors aren't sure which way volatility itself is going to go. So coming into the month, you saw vol as measured by an index called VVIX. So VVIX is an index. That tells you, it's an indicator, tells you about the implied volatility of VIX index options. A lot of investors to use that as a concept of how much uncertainty is there among traders and where vol is going itself. So to your points about how much VIX index or VIX futures are moving, we use the VVIX or point to the VVIX index as one indicator of market sentiment around that. So what drives so much trading in VIX options tends to be a lot of spread trading. So not surprising, we talked about the use of spread trading and the amount of spread trading in the SPX index and reasons why that can be useful in terms of making specific bets and managing premium spend or capping max losses. We see a lot of that in the VIX index options as well. So when I see 1.2 million contracts trading in the VIX index in the month of March, compared with about 900,000 trading in ADV in the month of January, or about 1.2 million in August last year, another big month. I think that was probably driven, and we see this in the data, by a lot of spread trading. And what's interesting about VIX is you see that on upside call spreads as well as downside put spreads, and you see investors using those in different ways. So it's often that we see investors buying put spreads on the VIX index as a way to take a risk managed bet that vol may go lower in the future. or buying call spreads on the VIX index, again, to do a limited premium spend, betting an upside move in volatility. And then as the VIX index and VIX futures move around, as VVIX moves, we often see a lot of investors actively managing those spreads, rolling in and out of them as the market moves. And that active position management, that difference in views people are taking, that's one of the big themes that we've seen in the market this year, as well as in some of those big moves last year. And the last thing I'll mention as well on the VIX index options, futures, and SPX index options is you think about the news around DeepSeek earlier this year, some of the questions around how risk on, risk off in other countries will affect the US. You see those trading in our overnight session, overnight from a US investor's perspective. And so we've also seen some big pickups in some of the overnight sessions as well for SPX options, and VIX options follows. That's also been a volume contributor for us.
Great. And, I do want to clarify something that I said earlier, because I mentioned the divergence in the VIX, and I want to be a little more specific on it. So, one of the things that I'm looking at here that is pretty remarkable from a trading standpoint is how the VIX actually exceeded its high from December. But then you take a look here at the SPX, and the sell-off that we had was a lot more severe this time. So that's pretty remarkable, I think. But then you had that big spike back in August, and the decline that we've seen now has been pretty steep, but still nowhere near what we saw in the spike going into that August high in the VIX. So does that mean that there's more volatility on the horizon? Because I think there's been a lot more reasons to be concerned and scared now based on what's happening in the economy versus what happened back in August. But that did precede a 50 basis point rate cut from the Fed in September. But the spike that we saw in August, still nothing like that. So that's one reason I think to be cautious in this tape. And I'm glad that you talked about what people are doing in this product because it's something that I think they should be aware of in this environment.
Yeah, we think it's just a helpful tool for people to have out there, whether you're actually trading it or just looking at those indices for indicators, like we talked about the put call indicator. And we hear from a lot of investors that being able to look at those indices calculated real time throughout the day as well as overnight is something they find useful as ways to get a quick snapshot of what his sentiment really is in the market.
Awesome. And I know that you recently came out with some crypto stuff, if you want to talk about that.
We did. So I'll direct you. I'm going to ask you to put up slide 10 here, just so I can start to give you some sense of that. So what you're looking at here are month-long ADV stats. So how much volume is trading in contract terms each day on average in a particular month. So I'll direct you all to look to the right hand. You'll see January, February, and March numbers. So really, I've been focusing my comments on those. So super relevant in the new geopolitical and political regime. So you can compare here in contract terms, SPX and VIX, with those kind of in the millions of contracts, really big notional long-standing products. Russell there in the thousands in terms of ADV, 84,000. But just to tell you, that's still 17 billion in gross notional traded. So it looks smaller, but it's still a whole lot of risk if you were to compare this versus other derivative markets in the rest of the world. And if you look down at the bottom, you can see MBTX. So MBTX are our new Bitcoin ETF index options. And it sounds a little bit like an oxymoron for me to say they're index options and ETF options in the same phrase. I'll explain how that works here. But that product, we only launched it in December, and it was launched in request from a number of different investors, including ETF issuers who were looking to launch new products using options that would correlate to a spot Bitcoin option, but to be able to distribute those to US investors in the right type of wrapper. So MBTX is our answer to that. So it is a cash settled European style index option. And you see zero ADV before January because it was brand new. But in terms of a new product launch, we're actually really excited about the volumes that we're seeing right now, and really a proof case with a new launch that there was real demand for a European style cash settled product. And so how did we come up with that? So the index that underpins MBTX, it's about a $200 index right now. It's 1/10 of a bigger notional product that we offer called CBTX. So what MBTX is, what the underlying index is, it takes about 10, 11, or 12 now of the different ETFs that track spot Bitcoin, takes the prices, tradable prices, and the official closing prices of each of those ETFs, use that ETF, uses those prices to construct an index. Then the options are against that index. So there's a lot of household names that you're probably familiar with, ETFs that are issued by and ARK and iShares, Fidelity, Grayscale, and others that are in that index. We also have a QR code at the bottom right where you can go to get more information on that. But in terms of average daily notional that we saw in the month of March, it's about $21 million of average daily gross notional trading in that product, which is really a big success. And if you sum that up with the CBTX, the kind of big sister, if you will, of MBTX, it ends up being about $45 million of gross notional in that product, trading every day. And in terms of the client feedback we're getting, we would expect that to only continue to grow. On some of the biggest notional days, the actual volumes traded end up being 5 to 10 times that ADV. So really excited about that new product.
Well, I think it's so very important. There's a lot of people in the crypto space that want to see Bitcoin become a bigger part of the financial system. And, steps like these, like you just explained, are what needs to happen. When you have these wide price swings in the market, the inability to hedge really deters away the institutional, type of traders and investors. So now that they have an ability to hedge, crypto, Bitcoin specifically, I think you're going to see it become a bigger part of, your everyday portfolio.
Yeah,
that's what's been missing. So
yeah, couldn't agree more. And it's been really fun for me sitting in a sales seat at Cboe to get to work with clients on these types of new product launches, and then to see them actually be able to use them in the way we intended, the way that we hope it works with new product launches, but doesn't always. There's a little bit of faith at the beginning, and this one's just been so exciting to watch come to market.
Yeah, I think it was a couple months ago I was talking to Rob about this, and I've been on the crypto scene now for well over a decade, probably closer to 15 years, and I asked him, hey, when's the Ethereum one coming down the pipeline? Can you talk about that yet, or is it too soon?
Great question. We are very excited about potential in that space, but a little too soon for me to say exactly what or when, but certainly encourage people to reach out to us if that's something that you want to talk about. It's certainly on our radar in terms of future innovations.
Awesome. Well, I'd be happy to take a look at some of the some crypto ETFs here. We'll start off with IBIT because, this obviously crypto's been selling off. It hit a new all-time high just a couple of months ago. But here too, it's very similar to what we're seeing in stocks, in the S&P specifically. You have this former support turn resistance zone, and you're pressing up on that. And below there, I think we have to exercise a little bit of caution. But above there, again, to me, this comes back to a higher low with respect to the longer term trend. Now, one of the other things that's on my chart here that, some viewers may have a question about is Bollinger Bands. And since we're talking about volatility, Bollinger Bands, it's an indicator that I like to use that I think does a really good job at explaining the type of environment you're in when it comes to volatility. And so basically the way I like to use this indicator is you have a 20-day or 20 period moving average, which represents this dotted line, right? So, you see a lot of traders out there talking about moving averages, and, Bollinger Bands do take that into account. But what I like is that it ties in the concept of standard deviations. And basically, when you start to see prices trade either below or above, the upper or lower Bollinger Band, it gives you a sense that you're a bit extended in one direction or the other. So this helps you as a trader start to think about strategies, whether it's time to hedge or bet on a sharp reversal. But basically, if you're below the lower Bollinger Band, we're looking for either a mean reversion or a pop back up to the upper Bollinger Band. And you can see this play out multiple times. From this low back in August, look how much further below you were the lower Bollinger Band, which again is 2 standard deviations from this 20 period moving average. So if prices are well below that, that tells you, you're probably 3 or 4 standard deviations away from the mean. As someone who's looking at volatility, that's something that you cannot ignore, because then you have the opportunity to basically bet for a reversion of some sort in the other direction. So, these are some of the things that I like to look at, and you can see how this played out again here in March, earlier this month, where you dropped below that lower band. You did get that reversion back to that 20 period average, but we haven't touched the upper one yet. And interestingly, that overlaps with this, support/resistance zone that we're looking at here. So that's one of the indicators I like to use to help measure where we are relative to volatility. Remember, volatility has a tendency to compress before it expands. When you're on the outer edges of these Bollinger Bands, that gives you a sense that volatility is expanded, and you're going to be looking for it to compress after. When you're closer to the 20 period moving average, you can start looking for an expansion of volatility. So that's how I like to use that indicator, and I think it's a good way to help develop some options trading strategies for those looking to either make directional bets or to hedge their existing positions.
Yeah, well, and one nice compliment to that, I don't have the today's stats in front of me, but in our volatility outlook on Monday, we started highlighting the compression that we've seen in implied vol for the MBTX and CBTX index options. That there's the implied vol, so the anticipated moves based on investor trading going forward had compressed quite a bit. And so we were noting that that might be an opportunity for investors to start looking at, whether as an indicator of risk sentiment or for potential trading ideas.
Yeah, so very important. I like that. And remember, the volatility can go both ways. You can get a face-ripping rally, and you can get another really sharp decline lower. So, some traders out there like to sell resistance. Others like to buy support. And, we talked about this, how we are pressing up on that zone. Are you seeing something similar in SPX as well, Kristin?
Not quite the same level. Yeah. In fact, earlier this year, we'd seen some pickup and downside vol, but I don't have the current stats in front of me for how that might have changed this week in conjunction with the Bitcoin.
Okay. Well, that certainly lines up with what I'm looking at from a technical standpoint. The other thing to consider when it comes to trends, I talked about how, SPX, even Bitcoin, longer term uptrends. You can have shorter term downtrends within longer term uptrends. And again, if these are, products that you're holding specifically like a Bitcoin ETF, the ability to hedge now, that's a game changer. That's a game changer. You don't have to sell the Bitcoin ETF, create a taxable event. You can sell that premium, hold on, get into that longer term, capital gain category. Because, if you're getting the kind of gains like some people do in this crypto space, I don't think you want to be paying, those short-term gains, in terms of the taxes. So, I think it's really good that there are much more flexible strategies now instead of just like the proverbial hodling, that acronym, holding on for dear life in the crypto space. You don't need to deal with all the volatility in crypto anymore. There are strategies, there are tools out there. We've seen kind of Bitcoin come of age, and it's trading like a big boy now. You can actually hedge and you can hold it and make it a mainstay of your actual portfolio.
Yeah, cool. Good. And while you're there, maybe let's do a little audible. I'd love to hear your views on the Russell 2000.
Oh yeah,
RUD index, because that's another one as we've started to see some investor questions, if you will, about U.S. broad economy, U.S. exceptionalism, things like that. And we've seen a real pickup in both the zero-date expiry trading and RUT index options, as well as just the overall complex this year. So love to hear what you see in that.
Well, the rut's got some issues. The rut's got some issues right now. The good news is that we made a new all-time high back in November, but nowhere near the all-time highs now. But that does give us a sense that the trend is still up. Now, if we do form a higher low here, that's going to help give bulls some ground to stand on. But you did just similar story to SPX and MBTX. You kind of got rejected at this former support turn resistance zone. The short-term trend is down. The long-term trend is up. But, you mentioned the whole, American exceptionalism thing when it comes to markets. I remember coming into this year seeing the consensus was, Mag 7 was going to dominate. US was going to continue to outperform. And the performance spread that we've seen from international and domestic stocks is the widest it's been in several years. I mean, I think it's been since like 2018 or 2017 since we've seen international do as well as it has compared to the US. But when it comes to the Russell 2000, once upon a time, we used to think that, a stronger dollar was good for the Russell. And now you have the whole tariff thing. So you would think that, maybe these domestic companies, which tend to be more in the Russell 2000, these multinationals, usually in the SPX, they get a lot of their business from overseas as well. You'd think that, maybe the tariffs would help the Russell start to outperform SPX, but it's not been the case at all. And it actually, I think, looks a little worse technically than SPX. But we know that, when stocks start to run, you can see a pretty impressive rebound. But when it comes to which one's going to outperform, I still think the bigger story is abroad, internationally. So, if a lot of these companies, even if they're not doing a lot of business abroad, they still might have business inputs that come from overseas. And if they get slapped down with those tariffs, consumers start to change their spending habits. That's going to create some issues. So from a fundamental standpoint, I can see the issues there. But from a purely technical standpoint here, I'm not really a big fan of the Russell until we can get back above 2150, 2200 from the long side. Until that, I think we need to be concerned with some more downside on the table potentially.
Yeah, thank you. And yeah, we do publish a volatility index on the Russell, similar to the VIX, but with Russell, the ticker for that's RVX. So that's something that we're starting to look more closely at in terms of its potential indicators as well. But to your point on international, we have seen some pickups in MXCF, which is MSCI's emerging markets index. So we've got options on that and seeing a pretty meaningful pickup in the volumes ADV there in the months of February, or from March to February. So I'd say that echoes some of your points on just increased trading around that EM theme, as well as more consistent flows in MXCA, which is developed market ex-US. But MXCF has been probably the more interesting one thus far.
Great. Well, the good news is that there's no shortage of opportunities to protect yourself in this tape. But like anything else, have a plan before you take on a trade. Don't trade based on the headlines. Don't trade based on the rumors of the day. As someone that trades, for full time type of thing, I'm not pulling the trigger on a whim. I have all my risk defined before I take a trade. I have a price target. Do your due diligence before taking on a position, whether it's hedging, whether it's taking a speculative swing in one direction or the other. That's the best thing that I could say, regardless of what your take on the market is.
Yeah. And maybe I'll give just a couple updates on some of the other VIX family products out there. So for people that aren't looking for market directional views, but are looking for pure vol, on slide 7, you'll have seen this before. We started talking about the VIX index options that most people are familiar with, but we've also a suite of other products to meet some different investor needs here. So VIX futures, that's the VX ticker. Those are kind of the next product that people tend to trade. So those are listed on our futures exchange. They have 1,000 multiplier. We've also seen some big ADV highs. 318,000 contracts a day in the month of March. That equates to something like $315 million of SPX Vega equivalent. So for those of you kind of a little deeper in the vol space, you'll hear what a deep and liquid market that is. But some of the products that people aren't as familiar with is we have VXM, which are the minis for VIX futures. So they're 1/10 of the size. Just makes them a little more flexible. And I'll show you in a moment some of the volumes in that. But we also have options on the VIX futures. So how do those differ from the VIX index options? And this is a conversation that we've been having with investors for the 2 years before we launched this product and continue to have now, is just helping people to make sure they really understand the differences. So these VX options, so those trade on the futures exchange. They're actually physically settled options, so different from the VIX index options, which are cash settled. So also a very different tenor profile. So these options on futures are actually options against the front month VIX futures. And there's actually 5 days a week of expiries. So while our VIX index options expire once a month on a Wednesday morning, these VIX options on futures actually have a daily expiry every day on the close for the front 5 days, and then you've got 2 Fridays after. So if you're someone that has maybe a little bit more down the complexity curve and is actively trading in VIX futures and taking those volatility views, and you want to be doing optionality in the short dated, that's the tool that we have out there. And we actually launched those in October of last year. We got those out before the US election, thinking that would be a useful tool for investors to give people a sense of another way to look at volatility. And those trade maybe around 100 lots a day. So still a nascent product, not growing as fast as the Bitcoin options that we talked about. But we do see steady customer flows that have been growing month on month as more customers start to figure those, find out that they exist, one, and then start thinking about different ways to incorporate them in their portfolios. So in terms of the volumes, I'll show you on slide 13 here how the volumes on some of these products actually stack up. So I've not put the big VIX futures on there because all the other products would look quite small in terms of volume, since those are about 300,000 a day. But you can see the biggest blue bar on here, that's the VIX mini futures, those 100 times multiplier product. And then below that, you can see that we also have some US corporate bond futures that have been gaining in interest amongst institutional clients. And also maybe some bigger kind of professional retail users. But those are products that they feel, for those of you in the ETF space, like an HYG or an LQD, these are futures versions. So pretty good margin treatment on those cash settled products with a quarterly expiry at a month end. And those are products that we've seen really gain a lot of interest as interest rates were moving around and perceptions of credit spreads have been moving. And then you can also see here some of the smaller volumes, but you can see getting into our options on VIX futures down the chart at kind of around 100 lots a day in the month of March. And I'd say that's the one, that and the VIX mini futures are two that I'd probably call your attention to if you're looking for some new tools in the volatility space.
I'm so glad you mentioned credit spreads. I love looking at that to help measure market liquidity. And it's something that I think is really susceptible to change in the next quarter. You know, we talked about what's been going on in Q1, looking at Q2, you know, QT coming to an end, more rate cuts on the table. So, you know, we'll be looking for those spreads to narrow. And in that case, you know, you're usually going to be looking at corporate bonds outperforming treasuries to the upside. That's usually what you see when credit spreads narrow. So, yeah, very good. Let's see. You have flex options. What's let's
We
talk about
do. Yeah, let's flip on to the next slide. So one of the things that I wanted to use some of our time today is just to call out some of the biggest trends that we're seeing that are multi-year trends. And flex options, that's certainly one of them. So you can all guess about how old I am from when I said I started out in this business in 2004. And so my career predates flex options. And When these came about in 2016, I really didn't think they would ever take off because it was quite cumbersome to trade them. And what you see here is just the real growth that kind of went into from that 2019, 2020, 2021. After that, this real pickup in growth coincides with some of the big growth in ETF issuers using options, specifically flex options, and I'll explain what that is in a moment, to execute different types of strategies with a lot more precision and choice than the puts and calls and expiries that you see on your screens that most people are trading. And with that came a lot of workflow efficiencies and a lot more investors having brokers, executing brokers, clearing brokers, order management systems that could actually access those markets in a really scalable way. So that's what you're looking at here. So what are flex options? So for investors that need a very specific strike or expiry date so that it can match a certain type of risk or exposure in their portfolio, that's what flex options. So I was at a big ETF conference a couple of weeks ago, and I asked the room, how many of you are using flex options or have in the past? And about half the hands went up. So actually, you're in pretty good company these days. If I had asked that question 5 years ago at the same event, I'm going to guess you would have seen 2 or 3 hands, maybe
Wow.
4. So that just shows you what that growth is. And when I actually looked at this chart for 2025 year to date, and we've only had a couple months of the year, you would think with all the market volatility, people would be gravitating purely towards the things that everyone else is trading, the normal listed options. And in fact, you're actually seeing really meaningful growth in volumes of that product. So that just gives you a sense of the amount of utility that some types of investors are finding in this ecosystem today. And so I'll be the first to say I was wrong 10 years ago on this. Turns out there's been a lot of innovation in this marketplace.
Cool. And then you're also seeing a lot of growth in the GTH volumes.
Yeah, so I'm going to take you here to the next slide and tell you just a little bit. And I just wanted to show you for scale how much growth we've been seeing in really that 2022 on. And something of a similar story in that there's just a lot more brokers that are providing access to this session, and question might be why. So when we see different meaningful market moves that maybe start in the overnight session for an event that happens somewhere else in the world, whether that's an actual market move or just a risk off scenario for something that starts small, that there might be a lot of leverage. So we'll probably point to August of 2024 as a good example of that, where there's a lot of talk about some of the deleveraging that happened in other markets spilling over into extra volatility in our and so that triggers triggered some meaningful pickup in trades and flows in that overnight session. And so to give you a sense of what that looks like today on the next slide, you can see that we're tracking over 100,000 options a day in January, February, March. And so you'll see just a lot more flow than compared with that 1, 2, or 3,000 lots back before 2020. And what's notable in that is that those numbers even mask what are the size of the flows in the really big days. So if you look on the next slide, I'll call your attention to January of 2025. So ADV in that overnight session of a little over 100,000 contracts. On the biggest overnight move, so the DeepSeek event, they actually saw closer to 300,000 contracts trading in that session. And how much is that in notional? About $170 billion of gross notional. And so if you're someone that is a night owl and also just wants to be positioned to be able to trade into some of those bigger market moves, we see a lot of demand from investors and from their brokers to get actually connected to that session. And then just to put a little bit of context on slide 17 for what that means in terms of previous history, you can actually see that we had 5 and I think 6 now, but 5 will show you different all-time highs in that session. So 200,000, 250,000 lots trading overnight in August on some of those big moves, almost 300,000 on the night of the US election, and not even that many big moves in the underlying market. And still you saw almost 300,000 options, 170 billion in gross notional trading hands in that session. So those are some of the things that are driving investors to want to have access, because even if you're not staying up trading every night, when things are actually moving, you want to be ready. So that's been, I would say, the biggest theme that we've seen in that session in the last 9 months.
Very good. And Cboe has a lot of resources to keep traders in the loop, and also for those that are looking to learn more about these products. Isn't that right?
We do. So on slide 18 here, I promised you at the beginning I was going to give you another opportunity to learn how to sign up for some of the resources that we put out from our derivatives market intelligence team. And just a reminder, I mean, this is, we think of this as a really critical investment that we make in all of our clients globally, in terms of giving you market insights and tools and indicators that are easy for you to consume and see. So this is our snapshot here of our weekly. So this is what came out on Monday. This was my cheat sheet earlier when I mentioned the decline in volatility in the CBTX and MBTX products. Is Mandy and Ed and Henry called that out in the note this week. And so this note is about a half a page of text. It comes out a little before the US Open on Monday morning. And then what I haven't shown you here is a bunch of different charts in the chart book that's included. So that QR code on the top right will take you to a landing page where you can sign up for that content. Even if you're signed up for other Cboe content, we only send you this if you actually sign up for it, just to respect your inboxes. And on that page, you also get a chance to also sign up for some of the monthly webinars that we do that really talk a lot about the new products that we're launching. You'll hear about those here when we're with Benzinga, but you can also tune in. We do those about once a month. We often feature traders as well and portfolio managers on that call. And they're usually anchored to one of the new products that we have out, or maybe one of the recent launches in the last year. And then we also have the Derivatives Traders Edge. That's another note that you can sign up for. It's a monthly newsletter that'll give you kind of a snapshot of all the stuff that we have out there from Cboe. And then lastly, on the next slide, I want to make sure that everyone knows about Cboe's Options Institute. So the Options Institute is our educational arm. So likewise, mentioning, how important it is, we think, to give you access to the indicators and commentary. Similar to that, we want all investors to have access to really high quality options education. So this education is going to be a neutral source of education. It's going to tell you a lot about really the basics, 101, 102, 103 from an options and futures perspective. And most of those classes are taught live online now, but we are working on enhancements and continuing to expand what we offer there. You'll start to see different languages coming online for courses, different time zones, as well as making more and more of our library available in the next year. So if you haven't tuned into that site in a while, worth another look.
Excellent. Well, I think it's one of those markets where you need to know what you're trading and what you're owning and how they work. So again, not a market to shoot from the hip. So I think it's great that you guys have this.
Great. Thanks.
All right, Kristin. Well, I don't have anything else to share or cover unless you wanted me to take a look at anything else.
No, we've hit on all the biggest topics that we've heard investors coming in and asking us about in the last couple months. So this is my turn to say thank you so much for having me join you today. And thank you to everyone who spent their time listening in. And we're an open door in terms of access to content and ideas and things like that. So welcome anyone on the call today to reach out to our teams at Cboe.
Okay. Thank you so much, Kristin. It's been a real pleasure.
Likewise. Thanks, Johnny.
All right. Talk soon. All right, everyone, that's going to do it for our session on exploring current volatility and market trends. Thank you so much for joining us. If you want to learn more, you can visit the Cboe website and the Options Institute, as Kristin mentioned. And we'll be back again in the future with some more education on trading matters for you. Thanks again. Talk to you.